What's good, y'all? It's Joel, and I'm coming at y'all with another video. So this video, this is going to be the recap for NAS100 for Wednesday, July 12th. And if we dive into the economic calendar, right, as you can see, this day is core CPI. So this is a day that I always stay away from. I never open up TradingView. I'm never behind the charts for this trading day, just because this is usually a very aggressive um, news driver in which historically CPI, what it does is that it typically pushes price aggressively in one direction, either bullish or bearish, right? And that's to take out a lot of traders. That's usually one of the days where a lot of traders blow accounts and they get sort of stuck in position either with like slippage or they experience heavy drawdown, margin call, etc. So this is a day that you just generally want to stay away from, and so it's better to not even open the charts to even consider trading on this day. But so this is the day that we'll be reviewing, and I just wanted to give my thoughts on NAS 100. Of course, for later in the week, right, the next day is core PPI, which I'll do a review on. In short, core PPI historically, what it does, it within like usually it's that first 8:30 candle, but usually within the first 5 minutes, you'll see that price um, wicks up and down, right? It wicks in both directions and takes out liquidity in both sides immediately after 8:30. That's another reason why I don't trade core PPI. Um, it just doesn't really make sense with my strategy. If my strategy is trying to target one liquidity pool to then take price in the other direction, if PPI takes out both liquidity pools by 8:30, there's nothing to trade. So usually I just stay away from both of these trading days. And with Friday, Friday's a legit trading day, so I would be behind the charts on Friday. But at least with this video, it'll just be discussing July 12th for core CPI, and you'll see what I mean. And we are back. So apologize for that. Just had some technical difficulties with my internet, but with the power of video editing, we are back. So I'll just jump right into it for uh, Wednesday, July the 12th CPI. So here, this candle will go from 8:15 to 8:30. So at this point, we want to mark the first swing high and swing low to the left prior to the New York session, which is 8 a.m., which I see right here. This is the swing high. I'll mark it as buy side liquidity right here, right? The highest point from this level would be highest point from this level way up would be this high, and then the sell side liquidity. So the most obvious swing low from this point would be this level right here, right? So super simple, super straightforward. Now at this point, guys, remember beginning at 8:30 CPI, so we wouldn't even be behind the charts like actually trading this. And you'll see why, right? As soon as I skip to the next candle, look how large that candle is right there. So this is why we stay away from it. Pretty much 75 pips or 77 pips. Like this is a massive, massive move that would take out a lot of traders. Like just imagine thinking price is gonna go down, right? And entering a sell, and then you see a candle like this go against you. Like it's absolutely insane. So not worth being behind the charts for this. But see, we see the massive move up. And even though we won't be behind the charts trading this, I still want to like go through the logic as far as like how I would still frame my setups. So this took out buy side liquidity, and knowing that it's a CPI, we're not really expecting a break of structure lower or any real opportunity to take out sell side liquidity. This is just gonna be like one way, usually one way, right? So we'll just go through, right? So this was the 8:30 liquidity grab. So now we can fast forward. And the reason we're fast forwarding is because we already know buy side liquidity was taken. So we want to see what happens at the 9:30 open, right? Because for the 9:30 open, we want to see another push higher. So at this point, it's 9:15, which is fine. But like, let's just say, for example, this was the high that gets made prior to 9:30. Once 9:30 opens, we want to see that high get cleared, then deliver a break of structure and a fair value gap. Um, once again, just highlighting that it's CPI, so we wouldn't actually be trading this day. Wouldn't even be like looking at the charts because we know like that this is not really ideal for us. So this is the 9:30 open right here. So uh this is essentially the logic that I go through every single trading day, right? Like after 9:30 open, I want to see the high gets cleared and then a break of structure and a fair value gap. So I've highlighted it here, waiting for this high to get cleared, and then boom, with this candle here, it clears the high. So when this candle create a new high, the lowest point, like the structure, swing low is right here, right? So if price reverses, we would need to see it break the swing low and then leave a fair value gap in the marketplace if we were to take a sell position. And essentially, in this case, I would just stock price. If it goes higher and higher and higher, I would keep moving this light bulb under like the most obvious swing low, like the structure point. So then once there is a structure break, then I'll be ready to take the trade. So here you see this high again, right? Like this high got cleared with this candle. So the most recent swing low is right here, right? And then we just continue, we just keep going. Okay, so here you see this candle right here, this long wick is what broke structure under this level, right? It was a clear structure break. However, did price deliver a fair value gap? No. I mean, you can make the case that this is a fair value gap, which technically it is, but remember, I mean, it's even smaller than that, but remember, um, when we're trading, we want to see when there's a structure break, we want to see displacement, right? We want to see an aggressive candle going in the opposite direction. So if we've been bullish, we want to see aggressive bearish candles. So we want to see aggressive black candles break structure and then leave um, an obvious gap. Like you don't want it to be where you have to like squint your eyes to like catch the gap. Like those tiny gaps are still gaps in the marketplace, but the larger, more obvious gaps are the ones where um, they're stronger, that they'll generally hold better than these tiny gaps. So in a case like this, I would just ignore this, right? Like I would want to see a much bigger gap. So in a situation like this, I wouldn't even consider this as a trade opportunity. What I would do is I would wait for another push above, right? So then we can get another break of structure. So I don't really care as far as like what's going on with price right now. Okay, boom. So we got another push up, right? So then the most obvious structure point now is this level down here, at this level right here. So we continue, right? We just rinse and repeat. And this is the same process on a normal trading day, right? If we see prices going up and up and up, after it took buy side liquidity and sell side still intact, we just stock price until it delivers a break of structure so we can go down. So boom, right? This high was cleared again. So this is the most recent structure point, right? So we just continue the process. The high got cleared again, most recent structure point, right? Because it makes a swing low. So we just continue. Boom. The high got cleared again, structure point. This candle high got cleared again, structure point. Well, actually, I wouldn't use this structure point because these candles here make equal lows. So, and I notice that the market usually doesn't consider these to be structure points when it makes equal lows, because that's just additional liquidity. So we would actually keep the last structure point at this level. Right? So this high got taken here, but once again, these are equal lows. So we wouldn't consider this to be the last structure point. This would be the last structure point right here at this level. Okay, so now you see another push higher here. Now this would be the last structure point because it did not make equal lows with any other candle. This is at its own level. This would be a structure point here. All right, we keep going. Boom. So you zoom in. You see that this candle here broke structure. Where is the brush tool? Yeah. So you see, right? It went lower than our structure point. So this is technically a break of structure right here. Now, I would be hesitant about taking this trade just because it did leave a fair value gap, right? This is sort of like a medium sized fair value gap. Like um I wouldn't be like entirely sold on this, especially like with price action. So if you see a push up like this, I would ideally want to see it just go straight down and like smash through structure, right, and leave like large fair value gaps. Here, I don't really like this long wick of a candle right here, and like price goes up, it sort of slows down, retraces a little bit, and then makes a rally. So this wouldn't be an ideal setup. Um, but like it technically fulfills our confirmation. So if this were a normal trading day and if you were interested in taking this trade, you could have. Now, one thing you can also do is you could also measure the high and the low to see where this retracement level is at. So in this case, right, this fair value gap is not even above a 50% retracement. So this would not really be a desirable entry. I don't use my fib too often. Like I would just use a fib to measure the move. Like if it was a break of structure to measure the move to see where the fair value gap is at. Because ideally we want to take the trade in a sell. We would want to take it above 50% so price is at a premium. Or if it were in reverse, right? If this were um a buy, uh then we would want to take price from a discount, right? So not really desirable, not really an ideal entry, I would say, but technically you could take this entry. So let's just say, for example, we took this entry, right? We would have our sell limit at this level here, right? And then we will put our stop loss at the very top up here, right? So this would be about 14 pips, and then our final target. Now, of course, we can take partials along the way, but our final target would be at this level, right, of the sell side liquidity. Now, once again, CPI, so we wouldn't be behind the charts. We wouldn't be actively trading or taking this trade whatsoever. Like, we'd just be doing our own thing and letting the market play out for the day. But let's see what would happen. So, if this trade were to activate, right, which it did here at this candle at 10:30, um, I would want to see price go down and close under this level. If price comes down and close under this candle because this was the lowest point from the new like move down, I would put my stop loss at break even to have a risk-free trade. Right, so at this point, right, you see this candle here, this candle broke down and closed under. So at this point, I would move my stop loss to break even, and this would be a risk-free trade. But thing with this trade is that it eventually comes up and stops me out. So uh, this would basically just have been a break-even trade. But as you can see, price continues, right? And it just continues on and on and on, and then it slowly makes its way down. Now it doesn't end up going all the way down to the bottom for the sell side liquidity. It eventually goes to like halfway in the range or like 3/4 of the range, right into probably like 50% of this imbalance. If we were to mark it with a fib, right? 50% levels right here. Yep, so it went just under 50% and then now it's, pushing back up. So faster, right? Yeah, so it pushed back up and like took us out here. So, I mean, if you took the trade, right, you could have potentially made profit, but for me, this would have been break even because I would have got stopped out at break even. But you see there, right? Just I wanted to use this day to highlight um, CPI that this tends to happen often, just because price is a repeating phenomena, right? Like these, I don't want to call it patterns, but like you see that these series of events repeats. Um, and the thing about CPI usually when it's negative and you see an aggressive bearish candle, that's when it's sort of like the SpongeBob meme where everyone's running around the office. I think it was the episode when SpongeBob forgot his name and it showed a clip of like all the hundreds of SpongeBob running in the office, like papers flying, everything's on fire. Like that's sort of how it was with like Wall Street and everywhere else that they always show these pictures of just all the all the stocks just plummeting, and you think like we're about to arrive at the next Great Depression, but that's never the case. It's just the market is 100% controlled. Everything's being manipulated. Like this is being done on purpose. Um, and you know, in order to keep people under control is to have them believe that all these events are random, that you know, the movement of the market is tied to the news when in actuality the market is being moved by an algorithm. Like this stuff just keeps happening. Like if if the market wasn't fully controlled, then you wouldn't really see patterns like this happening every single time. Where if you go back to your CPIs, because CPI happens maybe once a month, potentially like twice a month, um, it happens like you see this happening all the time. That it would just like shoot up or shoot straight down, and then it would just continue. Like you wouldn't really see it take both sides. So this repeats. So this is why I wanted to showcase why I don't really trade on this day. If you found this helpful, do leave a like, subscribe. Your support is greatly appreciated, and I'll be posting the next video shortly discussing PPI. So stay tuned for that. Once again, it's Joel. I'm out. Peace.